Market on close. We got 7 minutes until the bell. Joining me, Joe Mazzola is a head trading derivatives strategist, and Cooper Howard is a director and fixed income strategist at Schwab Center for Financial Research. Afternoon, guys. Joe, get us started here. Stocks finding some leaders outside big tech. How encouraging is that going into tomorrow's slate of data?
Yeah, I mean, look, Oliver, we're within stone's throw of all-time highs again. You've seen the Russell kind of join the party finally. If you look at kind of the sectors with the best breadth of recent, it's not tech, right? It's utilities, materials, industrials, financials, discretionaries. I mean, it's showing that we can extend beyond just the tech leaders and see some strength below the surface. And what I find is interesting is this is, with the backdrop of an earnings season that started fairly well so far. Only about 10% of the S&P 500 has reported, but the expectation for year-over-year earnings growth was around a little over 4% kind of coming into the quarter, and that had been dropped fairly dramatically from the about 7.5% expectations coming into the cycle, and we're right around that 7% now. So the bar was lowered maybe a little bit too much by the analyst, and the market's responding and rewarding those that are beating. Okay. As we get a lot of data coming in tomorrow, Cooper, what is your baseline for the bond market? We got a decent bid into treasuries yesterday, and not a lot of pushback to it today.
Yeah, so it looks like we're in a little bit of a holding pattern for now. So I wouldn't be surprised if we see a little bit of choppiness going sideways, Oliver. I think that if we harken back to that non-farm payroll report, that did raise the debate of, are we going to get a pause or are we going to get a 25 basis point rate cut at the next Fed meeting? So we know that the biggest driver in terms of yields is the direction of Fed policy. It's likely going to be lower, but how much lower and how quickly are we going to get there? I also think, obviously, we get the claims data tomorrow. That's going to be important given the given the attention and the focus that many Fed officials have been paying towards the labor market as of recently.
Okay. Joe, do you think bonds, if they sell off, stocks should welcome that? So far, they have the last 3 weeks. Is there any limit to the equity market's tolerance, say, if we start pushing to 4.2 in the 10-year?
I think the one thing that is maybe holding the equity market back is the fact that there's still a lot of hedging activity going on. You're seeing a lot of buying, whether it's, the SPX, but you're also seeing it in the NASDAQ and even the Russell, where people are paying a lot of money for these options. And I think the difference is that they're not getting rewarded for that. So I look at the spread between the implied volatility and then the realized vol, which is basically is the juice justify the squeeze, right? And so what we're seeing right now is people are paying up for these options, but we're not seeing enough movement in the market. Could be something around, maybe some of the gamma levels that we're seeing, and it's kind of forcing some of that compression of the equities, around these strikes. But at the same time, there's a lot of hedging activity heading into the next couple of weeks. Yes, we know the election and there's other geopolitical risks, but it'll be interesting to me to see whether or not some of that starts to abate a little bit, or if you continue to see more and more of these option buyers step in. Is that something that can maybe push the market one way or the other? Time will tell, but we're seeing levels right now in elongated VIX levels that we haven't seen in a couple of years, where we're trading above the 200-day moving average. Now coming up on the 64th trading session, where we've been above that 200-day moving average. That's something we haven't seen in a couple of years. So just interesting to kind of note.
Yeah, for sure. VIX has been pretty stubborn, edging down a little bit here this week off of 20. Cooper, looking at the shape of the yield curve and bonds, we had the bull steepener, but then since the Fed cut, we had a good bit of bear steepening. What do you think is going to be the contour going forward?
Yeah, so a little bit of a surprise maybe to some people is that the Fed cut rates and interest rates actually go up. We still do believe that the direction for the yield curve is more steepener. So we do think that it's likely that we're going to enter into more of a bull steepener, led by further declines on the short-term rates. Again, we think that the direction of Fed policy is going to be lower, so that should help pull short-term yields lower, Oliver. Now, I think that there's probably less likely upside on longer-term yields unless we have something like a growth scare or an inflation scare. As of now, it doesn't appear that any of those are in the cards. However, there could be a little bit of a surprise, but we think that probably for longer-term yields, it looks to be that there's a little bit of a cap there.
Okay. Well, right now, the cap seems to be holding on enough for volatility to subside a little bit, and equity markets welcoming that. Thanks, guys. Joe Mazzola, Cooper Howard.